Ladies and gentlemen, welcome back to another episode. I'm here with my guy, Marc Arnely. Born in Haiti, raised in Brooklyn. He's gonna be a part of the finance series I have, and he's here today to give you the great advice on finances in his journey. Welcome.
Hey everybody, my name is Marc Arnely. Like you said, I was born in Haiti, came here when I was about 2.5, 3 years old, raised in Brooklyn most of my life. Recently started traveling the world, so expanding my knowledge of cultures and everything, and also a little bit about finance, about how people treat financing around the world.
Nice, man. So we'll start here, man. So on my show, I like to talk to people about their blueprint, their foundation, how they got started. So let's start with, who raised you?
Alright, luckily for me, I was raised in a two-parent household where I still have both my parents, my mother and my father. They raised me pretty well, I would say. I know, it's different from person to person and
Right.
how you judge it, but I would think they raised me pretty well. In the aspect of finance, I basically learned how to save from them.
Nice. So you growing up in a household, was there some days or some nights where like, hey Mark, sit down here, let me show you this? Was it something like that?
Unfortunately, in my household, I think it's the same thing for many Caribbean households where growing up, they don't technically teach children about financing, only because they personally never learned about financing themselves. In my aspect, I was lucky enough to have a friend of the family who gave me a book about money when I was very young. I think I was maybe about 7 or 8 years old, where I think I still have that book till this day. I have not looked for it personally, but it taught me a little bit about how money works, how to differentiate how to save money and XYZ. When I got that book when I was young, I was very interested in it. I got it along a side of sets of other books, some including poetry and world history and stuff like that. But overall, the money one interests me the most.
Of course.
Of course.
Yeah.
But from there, I never really took money too seriously growing up, but I did kind of learn how to save money according to how my parents did, where they grew up learning to put money in the bank, and that's technically how I learned to put my money in the bank as well. When I was younger, I saved up for my own prom. So I paid for my own prom. My parents didn't pay for it. So, that was my first real, I guess, big adultish style of saving. So that was pretty interesting. And then from there, I've learned how to save properly, when saving is appropriate and when saving is not appropriate, because there is good and bad savings.
Break that down for every single body.
All right, so one example of bad saving what's called mattress money. So saving mattress money means having money put aside either under your mattress, in your shoebox. Don't get me wrong, it's not wrong to save a little bit of money like that, but you should not save all of your money like that. Mainly because one of the main reasons why that's bad is because year after year, there is something called inflation. I know everybody's heard about it recently, these past couple of years, inflation has been the highest they've ever seen in a very long time. And what that means is that your money actually loses value. So with a 9% inflation, say you had $100 saved last year, you can only, what you used to be able to buy for $100 last year, you can only buy for $91 this year. And what no one wants to do is lose money that they worked hard for.
Right.
So what I would say is have a little bit of emergency money up front, where, hey, I need $500 or $1,000 at maximum, maybe depending on your lifestyle and everything like that. Hey, this is money I may need immediately, and I don't mind it losing value because this is for an emergency. But other than that, you should be doing what's called good saving. With good saving, what you're looking at is maybe 3 to 6 months worth of savings for all of your expenses that you do. That includes rent, mortgage, car payments, insurance, your day-to-day living, things that you could not do without.
Right.
Um,
So wait, hold on.
mhm.
As you continue, let the world know what you do professionally.
All right, so as of currently, I am a mortgage banker. What that means is that I help families get into homes. I take a look at their finances, take a look at their income, and help them see if they can afford the home that they want to purchase. I've helped quite a few families get into their homes, especially recently. Right now, I'm actually working with a few families, getting them ready for their first home purchase or their next home purchase. So it isn't always the most comfortable conversation to have with a person, letting them know, hey, I know that you're looking at a $500,000 home, but you can really only afford a $300,000 or even a $250,000 home. And unfortunately, sometimes they do get upset about that. But the reality is that, you know, today's price is not yesterday's price.
Yeah.
And
Today's price. Yeah.
as the saying goes, yesterday's price is not today's price. And unfortunately, that is a reality that we live in, where just less than a year ago, interest rates were about 3%. Now they're about the middle sixes to sevens, where what you're looking at is being able to afford less home with the same amount of money that you had last year. And because of that, we do have to make sure that we put people in the best financial position possible, where, hey, I know you want to own a home, and this is what you can do right now. Let's help you get started, so that way, by the time you do find a home, we're able to get you into the home. It might not be the best home right now, but at least you have a foot in the door that you can utilize for your next step. And the main reason why I say that is because buying a home right now, don't get me wrong, homes are expensive, rates are high, but they're not the highest in history. Like, I actually did a project on this where interest rates were actually around 16, 17% in the early 80s. And if people today were to see those type of prices, I think we would have a right, unfortunately.
But those prices back in the day was like $20,000, $30,000, $16,000.
That's true. But remember, even though your buying power has decreased over time, technically the properties have increased in value as of, like, hey, they're worth more money, but it's only because, you know, inflation has risen so far that, you know, they have the price of property, real estate, and everything has gone up. And then there's the law of supply and demand, where if there are not enough homes, people are willing to pay more to get the homes that they want to get into. And that's kind of what happened during the pandemic, when everyone was leaving more urban areas to move into more either suburban or rural areas, where they could find homes farther away from people, away from, you know, the pandemic, the COVID, and XYZ people. So with that, the prices of homes were driven up because the people who could afford them were willing to pay cash for them, and the people who couldn't, unfortunately, had to look towards other ways of financing. And in this world, cash is king. Because cash is king, if someone's gonna pay you cash for a house right now, I want what's that JG Wentworth commercial?
JG Wentworth.
877 cash out.
It's not a sponsorship.
It's not a sponsorship, but it's my money and I want it now.
Yeah, it's my money. I want it now.
Yeah. So with that being said, that, you know, if they can pay cash for it today, I would rather have my money now, do what I need to do, rather than wait for everything to go through, paperwork to be done, and for me to find out that, hey, this person who's putting an offer on my home isn't able to afford the home that they thought they could. So
as if I'm a customer, right, I come to you like, hey, Mark, I really see this home. Would you rather me be the customer with the cash to pay the house, buy the house outright, or would you rather be the customer with the financing?
All right, so in that respect, I would never call any of my clients a customer, because the thing is, a customer just buys things and you probably never see them again. A client is someone you build a relationship with in order to not only help them now, but possibly help them in the future. So I consider anyone I work with a client.
Gotcha.
And in that respect, if you have the cash to buy a home, I probably would say you have to look at what you're looking to possibly do. Yes, you could, like, let's say you have $500,000, you could buy this cash. You could buy, like, don't get me wrong, the average price for homes right now are probably around $250 to $300. But like, let's say you found a $500,000 home, and that's the home you want to buy. You have the cash to buy it. The person is willing to pay, willing to give it to you. Now you have to look at your options. Are you facing other people who are paying cash for the home? And if yes, then I actually would recommend you buying the home cash. But if everybody else is putting an offer on the home, I would honestly say instead of paying full cash for the home, finance it. Pay 50% down, finance the home, and use the other 50% to buy another home that you could, you know what, get rental income on. So now you're not buying a home just for yourself and paying a mortgage. Now you have another property that you're getting rental income on. And the sad thing about looking at that fact is that when it comes to financing, there are a lot of people who tend to rent currently versus own their own home. And if you look at the broad spectrum of a lot of things, like you can actually look this online. I don't 100% recall the numbers, so don't quote 100% quote me on that. But the average net worth difference between a person who owns their own home and a person who rents is about $180,000 to $240,000 difference. So that means your net worth as a renter is probably somewhere in the range of $50,000 to $60,000, versus your net worth as a homeowner would probably be in the range of mid $200,000 to $300,000.
So it's always better. It's like it's better sooner to buy a home rather than rent 10, 15, 20 more years.
That's correct. Like if you can save the money right now, if you have the money to buy a home, even with interest rates being where they are, what a lot of people don't consider is that you can always refinance down the line. When you refinance down the line, that means you can lower your mortgage, you can lower your interest rate, and you still have value in your home. Right. Not only that, homes year after year tend to increase in value. So that means if you do choose to sell it 20 years from now, you've gained a net worth of, let's say, upwards of maybe 30% or something like that, maybe 50% even, and depending on where you're selling your home. And with that being said, you're able to leave some type of asset for the next generation if you choose to do so. And that's one thing that's kind of I shouldn't say over, but maybe underestimated in the Black community, especially Caribbean community, where we look at buying a home as an asset for ourselves, but don't often think about how to make that asset make money and generate income for the next generation. So that's something that we should, not just as the Black community, but like minorities in general, take a look at as how do I continue to generate income for my children and my children's children. And I know I'm about to go on a tangent right now. But
go ahead, man. Do your thing.
But one thing that I've actually been looking into is what's called a trust fund. With a trust fund, that's probably one of the best things that you can do for the next generations, where it's not owned by any particular person. How to go about setting it up, I would definitely recommend talking to a finance lawyer about what it takes to set it up in order to have generational wealth and income continue to generate for those who come after you. But that means that your children can't squander it, your grandchildren can't squander it, and they're able to get some type of residual income on either a monthly, quarterly, or yearly basis. That means that, hey, what I establish will not be destroyed by the ones who come after me. And the reason why I think it's one of the best things to do is because depending on how you grow up, your mentality and how you approach money vastly differs. Someone who comes from money, they will look at money as a commodity in order to get what they want. So, hey, I want to spend a year in Europe. How much money do I need to do this? And hey, mom, dad, or whomever, I need this X amount of money to do what I want to do for this trip. And that's how they go about it. They don't consider how much money it is, they just consider, hey, this money is what I need to establish something. For those of us who come from a less well-off family, we look at money not as a commodity but as a necessity, where, hey, I need to put in so much hours at work to make this much money. So for us, money has a different value, as in we tend to overwork ourselves just to have enough money so that we're not living paycheck to paycheck. And even then, some people have 2 or 3 jobs and are still living paycheck to paycheck. And why? Because we aren't often taught how to manage our money and how to create residual income for ourselves.
How do we change our mindset with that? For someone who comes from a low income or family, not being taught those proper foundations in financing, what is your tips of changing someone's mindset? You know, from start from the bottom to getting to a safe environment.
Well, the first thing I would say is writing down a budget. Like, it sounds super simple, but writing a budget out makes a vast difference in how you see where your money goes on a month-to-month basis. So let's say you tend to spend money on shoes, sneakers. I don't want to. I hate saying it because it sounds like a stereotype or something like that. But like, let's say you spend it on things that can be seen as frivolous.
Right.
When you take a look at what you spend on non-necessities, you can then budget. Hey, this is how much I spent the last 6 months on things that I didn't actually need, that didn't bring any value to me. Now, what can I do? What can I cut out? Or how can I reduce the amount of money I'm spending on things like these and learn to invest it in something that will bring actual income to me or build wealth for me? One thing I would say is, you know, a lot of people say this and I don't disagree, is investing in the SP 500. Investing in an SP 500, that means that you are investing in fractions of the best well-off companies, the best 500 well-off companies in the U.S.
Fortune 500 too.
Correct.
So, break down step by step. I'm little John from the street. Hey, Mr. Mark or Mr. Arnely. I see you talking about S&P 500 on Ron's show, but how exactly do I do that?
All right. Once again, not a sponsorship, but let's take the Robinhood app for an example. If you want, you can utilize that to start your investment process. Hey, I have an extra $10 a week that I already put money aside for emergency. I put money aside for the next 3 to 6 months, or maybe even a year if you want to be extra safe. I have all of my bills are taken care of, and I have an extra $10. What do I do with this $10? Do I keep it in my pocket? No, because that money loses value on a day-to-day basis. So what you do, you invest it into the S&P 500. Yes, you're buying a fraction of the companies that are out there, but what you're doing is you're safeguarding yourself against inflation. Now, we tend to put money in the bank, and we think the bank is the safest place. But do you know what the bank does with our money?
They reinvest it in something else, right?
Exactly. They lend it out to other people on higher interest rates in order to make money off of that. And what they do is they're using your money that you put in the bank in order to make more money with that. Now, tell me, who should be making money with your hard-earned money? The bank or yourself?
Me.
Exactly.
Oh my goddamn money.
All right. So, and I know like a lot of people, they're a little bit nervous about the stocks, like especially as of the last year and a half, almost 2 years, the stocks have been kind of rocky. Market has been kind of shifty.
Right.
People are a little bit afraid of it, but on average, year over year, we tend to see like a 7% return on our on investments with the S&P 500. So that's why I say like taking a look at that is probably the next best step to do it. Like I'm not telling you, hey, just go invest your money without any research. I'm not telling you what to invest your money in exactly, but I'm saying, hey, do the research, see what you would like to invest your money in, and then go for it from there.
Where would you look if you was looking online? What's the first word would you search in the Google bar or something like that? How would you search for learning how?
All right. Honestly, there. To be honest, there's a lot of YouTube videos on how to invest your money, or believe me, don't just take a YouTuber's name and a word for where to invest your money. Always do your research, because the worst thing to do is put your faith and your money in someone else's hand and just leave it to chance. I myself, once again, I'm not endorsing anything. I'm not sponsored or anything like that. But one of the things that I'm very interested in is the tech sector. I am a nerd by way of life.
Right.
I like anything tech. I always pay attention to it. And one of the things that I'm taking a look at are things that that may be up and coming in the near future. One of those things being batteries. More efficient batteries, better ones that go further, ones that last longer, like stuff like that. So I've been taking a look at that kind of market to see where I should invest my money in. Some of them, there are certain companies that are building better batteries right now. They're probably not going to be truly available for like maybe the next 2 to 3, maybe 5 or more years. But it's something that you want to keep a pulse on, because what are some things that are very, I guess, popular in the market right now, or very popular in the media? One of them is being EV cars.
Yes, yes, electric vehicles. I say another 10, 20 years, it's going to be down south with the gas vehicles areas. And
that's a very close possibility.
Very close. And I would say I would want to invest in the EV, the chargers, right outside of this home. If I was an electric car owner, I want one of my little electric docks right there, or a company that owns electric docks.
Yeah.
Put those on every corner on the block or so.
Exactly. And you know, as a matter of fact, if someone wants to start investing in something, invest in things that you buy. Like
toothpaste.
Yeah. So like, let's say you buy a lot of Nike products. Buying Nike products does not put money in your pocket, but you know what does? Invest in Nike stocks. Because if you're buying it, that means other people are buying it, meaning that, hey, they're selling. So if they're selling, their stock prices go up. That means you're investing into the company, you're buying into a company that you like, that you know that sells, that has had profits year after year. That's a way for you to, you know, start investing money and learn. Like, those are like the ones that don't technically blow up overnight, but you're slowly building wealth over time. And investing is not a overnight get rich quick scheme. Honestly, investing is a long, drawn out process where, as you slowly build your portfolio, you slowly invest money into things that you do understand, companies that you believe have a future where their profits are coming either not tomorrow or not today, or but sometime down the line, that you do believe that they will make it. Then those are the ones that you kind of want to take a look at, research them, and see if it's worth your money.
So when should you be aggressive and when should you be conservative?
All right. So in that respect, I'd probably have to ask you to kind of expound on what you mean, where to be aggressive and conservative, because that could vary from situation to situation.
Say, all right, I learned that the younger you are, the more aggressive you can be.
That is very true. You know, and the reason why is, when you're young, you have very little bills. Now, if you can, like, don't get me wrong, you're young, you're not thinking about, you know, your future too much, depending on your lifestyle currently. When you're young, the amount of money that you get, you're thinking about instant gratification, like, hey, I want this burger, hey, I want to go out with my friends. One of the things that makes us very broke is what they call keeping up with the Joneses. Like, you see a friend has a brand new car and you want a brand new car too. but you don't know what your friend's financial situation is. You don't know how they got their car. You don't know the process that it took for them to be able to do so. And now you want to keep up with the Joneses, and because of that, now you're putting yourself into a worse financial position.
Right.
And one of the worst things to do is put yourself into a bad financial position just because you want to be cool or you want to keep up with the Joneses, as I was saying. And but as you were asking, to be aggressive with being able to invest your money, the younger you can do it, the better. When
Because
you
compound interest.
correct, compound interest is very important, and not a lot of people understand how compound interest works. Let's say you have a bank account that gives you 5% interest year after year. You put $100 into it this year. Next year you have 105. The year after that you're gonna have $106. The year after that you're gonna have 107. And as it's growing, my math is horrible, but like,
I understand.
but like instead of 105, you would have like an extra $6, so 111.
Yeah.
So it builds year after year where you're getting more and more money overall. But when it comes to compound interest, not a lot of banks truly do compound interest. They kind of have somewhat simple interest from what I've seen, or the interest that they're giving you, even though it's compound, is very minimal.
Right.
Where you're getting 0.1%.
Right.
And what is 0.1% on $100? That's 10 cents.
Right.
For a year. So that means I lent you my $100 for a year, and you're giving me back 10 cents for it. Like, that's laughable. Meanwhile, they lent your $100 out to the next person for, at minimum, 7% interest, and they got $7 for it. So that means they made $7, gave you 10 cents, and they kept $6.90 for themselves. Now, tell me, is that fair?
Not fair at all.
Exactly.
That's that BS.
As they would say, yes, that is that BS. But what I would say is definitely keep your finances as best as possible in a way where you're not only putting money into your own pockets, but you're looking at your future. When you're investing money into a bank, like I said before, 3 to 6 months, definitely. A year, if you want to be super conservative, that gives you the ability that should you lose your job, should something happen, should there be like a major emergency, that you're able to still keep yourself afloat for the next 6 months to a year, where that gives you the peace of mind to know, hey, I am not scrambling to find the next job. I can figure things out and find out my road for myself moving forward. Another thing that I see people will do pretty wrong is credit cards and debit cards. Now,
break down credit card, debit cards, and credit scores. The importance.
All right, so when it comes to credit scores are probably the most important thing in the U.S. It's more important than having money, to be honest. If you have, don't get me wrong, having money is, pretty big up there, but let's say you want to finance something, even if you have the money to do so, if your credit score is not great, it puts you in a bad position. Right now, what's considered a decent credit score is 680 and above.
680.
680.
So with that, how can somebody use their credit score to get a line of credit?
All right. So in that aspect, so let's say you have a 680 credit score. Mind you, looking on Credit Karma is good enough for when you're thinking about getting a credit card, but it's not the same thing as when you're buying a home. But we're talking about credit cards right now. So what I want to say is get a credit card that you see yourself utilizing for things that you already buy. So I myself, just to give you a little history on myself, I started building my credit maybe about 11, 12 years ago. By building the way I started building my credit, I applied for a credit card and I got denied. I didn't realize why I was denied and that's probably a story for another time, where I had like I was not aware that I had my identity stolen before, so that caused a whole rift, and I had to build from scratch. But I figured it out, and I'm in a much better place right now. As a matter of fact, I'll give you my credit karma score. As a matter of fact, my karma score is over 800, which probably means in reality it's probably around 780, maybe 790 to be honest. But
it's an Equifax score.
Correct.
Gotcha.
So that's where my credit score is at overall. Just so that you guys kind of have an idea that, hey, I'm not just someone with like a 300 credit score trying to tell you, hey, do X, Y, Z, and you'll be fine. But and as a matter of fact, as a mortgage banker, you can't have a bad credit score, or else how can you give people financial advice? So that's kind of like a requirement for that as well.
Right.
So for people who are looking to go into that field.
Okay, so how did you get into that field? Like, what sparked your interest?
Honestly, I took a look at the flip in the market during the pandemic, and to me, it made sense for me to pursue that career. Right now, it's actually one of the toughest markets that you can take a look at for trying to build a career in the mortgage industry. But it's also a time where it gives you the most opportunity to learn, where people won't just qualify on a whim. So that means you have to do your due diligence. You have to look into all aspects that could help a client qualify, as well as what could make a client not qualify, and teach them how to get to where they need to be in order to be able to finance their first or next home.
So with that, right, with the knowledge that you know now and things that you learned through your career so far and your personal experience, there's a 18-year-old version of yourself, or even early, like a 14-year-old version of yourself, seeing this, wanting to know how can they start now, what would you say?
Take that $100 that you keep in your sock and go invest it into something. That's what I would tell my younger self.
So with banks nowadays, sometimes you can't open a bank account at a certain age. So, would you need like something like it's like a custodian account?
Yeah, where you have like a guardian who helps you open a bank account.
Let's break that down for me.
So basically, yes, if you're too young to open a bank account for yourself, that means you're under 18, definitely have a parent or guardian, help you open up a bank account where you can put money into your bank account on a regular basis. There are a whole bunch of rules about how to save money. And the first one that I technically take a look at that makes a lot of sense to me, is called paying yourself first. So before you take care of bills, before you take care of anything else, pay yourself first. That means I myself take 10% of my income and I save it. That means this money is going towards a purchase. Now, I myself have 2 checking accounts and 2 saving accounts. Just to be fully upfront with you, I have 1 checking account where my money comes into, and that all I do. Like I have not used my debit card in over maybe 8 years or so. When I tell you I don't use my debit card, I truly do not, unless I need to pull cash out from an ATM.
Man, break this, Jim. This secret down.
All right. So the reason why. No, before I get to that.
Yeah, okay, all right.
Before I get to that. All right, so my checking account, all it does is it take any deposits that I get, that means my check, income, whatever I'm bringing in, goes into that account. Then I have another checking account that's separate from that where I pay bills out of. That one is for rent, for certain small tenancies, the one that I use to pay cards and everything like that. That's where I transfer money over to that specifically for that. Then I have 2 saving accounts. One that I have technically I had to save twice for it. The first time I saved on it, I saved enough to open up a brokerage account. I myself personally bank with Chase. In order to open up a brokerage account, you do have to have at least $50,000 in order to open up one. So that just tells you like, hey, this is the first savings that I had to do with that particular account. And then I saved another set of money that I think I'd be safe for the next 2 years should anything happen to me, just to kind of let you know how that account looks like. Then I have another saving account where this is the one that I do for pay yourself first.
Right.
This one, it takes 10% of my whatever deposits, income, and everything like that that I am receiving, and I put it into that. That means this is what my next trip is coming out. This is what my next car that I'm probably thinking of purchasing is going to come out of. So that way I have separate money. I have my money separated into different categories in order for me to know how I'm spending my money and budgeting. For myself, this is where the credit cards come in. Is I have a spreadsheet for how much money I owe on any of my credit cards, when the due date is, and what is my minimum amount.
Right.
Now, in order to keep your credit score as high as possible, you never, ever want to late payment. And that is very, very, very imperative. There are certain companies that will allow you a one-time slide, where if you had a missed payment after years and years of on-time payment, they'll, give you the benefit of doubt, remove it from your history and everything like that, and keep you moving forward. But if at minimum, you always want to do the minimum payment if you can. But minimum payment means that you're paying interest, that undue and unnecessary interest on money that you've already spent.
So, what is the smartest way to pay off a credit card, and really how to use a credit card?
All right. So, this is how I do credit cards. And mind you, I have close to like 12 to 14 credit cards in my name. Whenever I'm applying for a new credit card, I don't just apply for a new credit card for the sake of it. I take a look at what I'm looking to do within the next 3 to 6 months. I'm taking a look at credit cards that would benefit me, that I would use on a regular basis, that have points that I could utilize, that I say this makes sense for me. And then I take a look to see what does my expenditures look like for the next few months, to see if I will be able to hit the bonus. So never get a credit card just and then spend, like, let's say I had got when I had received my Chase Sapphire Preferred card. I had already planned to go on a trip, and the trip was going to cost me close to $4,000 or $5,000. So at that time, I had gotten the card because, one, I'm already about to spend this money, so if I'm going to spend the money, I might as well get the points for it. Two, there's a sign-on bonus for spending $4,000 within the first 3 months on the card. So I was already planning to spend this. I already have the money saved, and I'm gonna get the sign-on bonus, so why not?
Right.
And three, will I continue to use this card in the future? Because it is a good travel card, and I do tend to utilize it a lot when I travel. I said, yes, this is a card for me, and so I applied for the card, received it, and I utilized it and got the sign-on bonus. I would never recommend applying for a card, spending money that you don't have for things that you don't need, just to get a sign-on bonus. There are quite a few people who play what's called the credit card game, where they'll apply for cards that they know that they're going to use, that they'll be able to maximize the sign-on bonus for, or maximize the points and rewards that they do receive on it, in order to, get as much money back from it as they spend, in order to feel like they're not losing money out on something.
Right.
And I recommend learning about it, applying it to your life, and treading carefully as you move forward. I have a particular card, the Capital One Saver card. Once again, none of these are sponsored.
Right.
That I use purely.
It should be.
They should be. That I use purely for food.
Right.
Like when I tell you, anytime I'm purchasing food, that means anything through Grubhub, through Uber Eats, through DoorDash. If I'm going out to a restaurant, that's the card I use. As a matter of fact, what I'll tend to do is everybody at the table, like let's say we're having a dinner party, everybody at the table, like instead of splitting up among everybody's card, hey, send me the money, I'll put it on my card, and I'll take care of it. Now, I was able to pay for my food. They were able to take care of their food. They sent me the money so that they didn't have to worry about having to pay off their card later, and I was able to reap the rewards on that particular card that saved me. Maybe like let's say, for myself, I spent $50 for myself, but the table spent $800 just to say.
Yeah.
So I got points on $800 instead of $50 right there. Now, is it a scheme? Honestly, I don't think so, because I made everybody's life easier. I took care of the bill, but everybody sent me the money. It created less headache for everybody. The waiter got their tip. Everything's taken care of.
At a group location like that, right? Say you pay for everybody's food, but ain't nobody want to put in no tip. Do you do like, hey, I'm gonna everybody give me their money, and I'm gonna add in the tip for everybody. Y'all also gotta pay that too as well.
No,
or
that's established. Like honestly, that's one of the things that you want to do. You want to establish information like that prior to anybody even giving $1, because you want to establish, hey, we're gonna like either service was great or service was terrible. Either way, this is what the tip will or will not be, and you move forward from there. Honestly, certain companies have automatic gratuity.
Right.
So with the automatic gratuity, it's already included. So you're not doing an extra tip on top of that more often than not. And so you split the bill, and then everybody's taken care of, and then you move forward from there. But let's say you go to a semi-fancy restaurant and you're on a budget. One thing that you want to take a look at is having a conversation with everybody at the table. Hey, I'm on a budget. This is what I'm looking to do. I do not want to overspend, and I don't feel like it would be appropriate for me to take on other people's bills just because.
But are they assuming that you're paying for it anyway?
No. Like it depends on the crowd of people that I'm with. Like, there are certain friends that I don't mind. Like I've had instances where I've left my card with like I've gone out to eat with friends. I had to leave. I've left my card with certain friends. They took care of the bill and everything. Everybody sent me their money, and I picked up my card from them the day after, or whatever the case may be. But that's only because I trust those people in that respect.
Right.
But you can't do that with everybody.
Hey, just hold this card. I'm giving you this card now. Get your food and go next. You seen charges for it.
Yeah. You can't do that with everybody, because you gotta know your limitations. But overall, I do have that conversation ahead of time. Hey, I'm willing to put the bill on my card. Everybody's just sent me the money. We take care of it. I get the points. Bill's taken care of. Everybody gets go home happy.
Right. No stress on other people.
Yeah, no stress. No stress on us.
Uncle Bucky ain't never. Hey man, can you give me this time?
No.
You know what I'm saying? All that.
Like there are certain people I'll give them like a time frame for, but that's because I've had that relationship established with them, and I know they're good for it. Then they're like, hey, I just met you, I don't know you, hey, just send me one now. But one of the things is, back to the subject at hand, with the credit card game, you definitely want to get quite a few cards. Like I'd probably say apply for maybe 1 to 2 cards every year or so, or maybe every 6 months if you're feeling frisky. Yes, does this affect your credit score? It can. Do I recommend doing it every 6 months? Not technically, unless you foresee yourself, either getting a sign-on bonus from a card, or you see an expenditure for yourself that you foresee yourself using the card for, and from there you have an avenue that makes sense for you to get a card. Every single card that I have for a specific reason. I have a Chase Freedom card that I use for my day-to-day purchases. I have a Discover card that I use mainly for groceries. I have my Chase Sapphire card that I use for travel. I have a Hilton cards with American Express that I use particularly for Hilton when I stay at the Hilton. No, I'm not that fancy. I just like the Hilton sometimes.
So is it just allocated? So you have your life allocated.
Yes.
It's almost like, hey, this money goes here, this money's going here. It's like allocation.
Correct.
So is that requires discipline?
It does. And sometimes discipline means not having fun because, like I said, when you, like, let's say you get $1,000 for your paycheck. Paying yourself first means that 10%, you automatically take $100 out of that and you put towards your savings for whatever the case may be. It means you have $900 to work with. Once you take care of your bills, whatever is left is your quote-unquote play money. Now, when you, let's say you have $600 of monthly debt that you have to take care of on a regular basis. That means you have $300 to quote-unquote play with. Now, what do you do with that $300? Now you can do another thing. You could do another pay yourself first, where you take 10% of that $300, put that towards savings again. Take 20% from that $300, meaning you take another $60, invest that into something. So now you're down to $210. That means you now have $210 that you can do other things with. That means go out, go eat, enjoy yourself.
Right.
Where you don't feel like you're like
spending money.
Yeah. Mind you, don't get me wrong, like, you know, life is a lot more expensive than that, but I just wanted to use that example so that you kind of have an idea.
Especially in New York. Especially in the cities. In the South, yeah, you can ball out.
Yeah.
Go to the mall and ball all day.
Yeah, but like, that's like an example of what you can do in order to not only continue your savings, but now you're also investing money that will continue to generate more money, and you're not feeling like you're completely tied down. Because I feel like a lot of people, what they tend to do is they pay their bills first, then whatever money's left, they tend to spend it on other things, and then now I can't save any money because I have no money to save. But that's because you frivolously spent money on things that may have been unnecessary,
right,
or not needed, or temporary, or just a loss for yourself where it doesn't generate any income for you. It doesn't better your life. It doesn't do anything for you in that respect. And from there, you're kind of at a loss. Now, I know like we're kind of jumping back and forth a lot, but for me, the way that I handle my credit cards on my spreadsheet, I have my due date as 2 days before it's actually due. So that means I will always make sure that it's paid by the due date on my spreadsheet, so that way I never have to worry about the actual true due date. It's like what the people who set their alarm 10 minutes earlier, so that way they have 10 extra minutes to make sure that they get to work on time. So it's that same kind of mindset that if you have that, you're able to move forward with more discipline. Now, we technically live in a very instant gratification society where, hey, I want to do this, you can't take your money with you, and I 100% agree. You can't take your money with you.
Just pass it down.
But you can pass it down. You can do something to better the lives of those around you. You can do something to better your life when you retire, because a lot of people, they think that their 401k is going to be enough for them to retire, and that's technically not true. What you want to do, you want to invest money. You want to invest in purchasing a home. You want to invest in things that bring you wealth. Whether that means not only having your own home, but an investment home where you generate income from, or you have stocks and a portfolio where you can get dividends from if you choose to do so, or reinvest the dividends so that you get even more money later down the line, or maybe utilizing some of your profits to join a venture that you truly believe in, that you see a future for, and hopefully generate money from that. So there's like many different avenues of how to build your wealth, how to generate finances and everything like that people don't tend to look at, only because on average we're looking at life on a check to check basis, where what I have all these bills, what can I do about these bills right now. I have my kids. I gotta take care of them. Like, mind you, I don't have kids currently, so my expenses are a little bit different from those who do have kids.
That's true. Because you gotta take care of little Johnny, little Bree. You gotta check. You got daycare. Sometimes in some places $400 a week.
That's true.
You know, sometimes $400 a week, or you can say $1,000 a month. Top of your regular bills, you gotta come home and eat.
True. And they eat, and like to be honest, like recently, one of the things that I started utilizing HelloFresh. Once again, this is not a sponsorship.
It's not a sponsorship.
I have to always iterate.
But if you want to sponsor me, send me a code, Ron and Riches. Use that and get 10% off.
Yeah, definitely. I endorse that. But like with HelloFresh, like I'm spending a certain amount of money for the week, and I already know what my meals are for X amount of days. And so with that being said, I know I'm not spending extra money out going just to buy junk food or eating. Like a lot of us tend to eat with our eyes, like
especially New York. Oh my God.
Where we'll go outside to the grocery store and we'll buy things that we don't really need.
Because we're hungry as hell.
Because you're hungry and like, oh, look at this. This is interesting. I could use this. And then you tend to waste money because either you don't fully utilize the products or they spoil before you even tend to utilize them or whatever the case may be. And in that aspect, with HelloFresh, I have my meals already planned out. I know what I'm going to eat on Monday. I know what I'm going to eat on Thursday. I know what I'm going to eat on Saturday. I know what I'm having for dinner, what I'm having for lunch. The only thing I got to figure out is what am I going to do for breakfast. I tend not to be a breakfast person.
Yeah, I'm not. I got to the point where my body, I started this fasting thing a few weeks ago when I started working out back heavily again. And after 9 o'clock, I can't eat. I don't eat anything after 9 p.m. I just got to drink liquid soda. And since then, my body kind of did some sort of weird thing where
it adjusts.
I'm not hungry at all during the day until around. So I had breakfast this morning, but yesterday I woke up at 7 o'clock, and the only thing I had is a bottle of water, and I got back here at 8 o'clock p.m. I had one meal.
Yeah, I tend to be the same too, but I'm trying to be a little bit more healthier because I realize that I'm not eating the way that I used to.
Right.
This is not a health and fitness interview, but I'm just sharing a little bit about myself. Like I've been trying to take care of myself, take care of my mental health, as in like even doing therapy and stuff like that.
I love
like
therapy.
once a month, just to have someone like you can talk to.
Right.
Unbiased. And get some feedback on.
You say whatever you want.
Exactly. Taking care of my body, like I'm working out on a regular basis and everything like that. Now I just need to eat healthier, so that way I can take care of myself as best as I can. And it's been working out for me, so I would recommend it. If you can afford to do so, if you think that might be an avenue for yourself, I would definitely say take a look at it, like maybe do a week or two with it and see how that works out for your life and see if you can move forward with that.
Nice. So what is your books that you recommend for people to read about on financing? What is your words of wisdom, and how can people reach out to you to start the process of purchasing home? For small tips, are you a certified advisor or anything?
I would not call myself an advisor. I am a mortgage banker, but I am a licensed mortgage banker.
Nice. So you can give tips.
I can give tips, yes.
Perfect. So how can people reach out to you for mortgage banking, your words of wisdom, and recommended books?
All right. So how to reach out to me? So you can reach out to me on my work number. That's 929-333-5181. You can reach out to me in email for my work email. That's Marc Arnely, MarcArn as in Nancy, ELY @rocketmortgage.com. And words of wisdom, I would say before you put your money anywhere, do as much research on it as you can as to where you're putting your money. And if anything, feel free to reach out to me by text or anything like that, and let me know who you are and what you're looking to do. So that way I kind of have an idea of how to help guide you on the next steps. So that way, you know, I'm not just having you just plunge headfirst into the dark ocean or anything like that. Because when I tell you it's a vast ocean of how to, you know, start investing, how to start having your money make money for you. Like, people go into real estate, people are what they call angel investors, where they feel like something has a potential to do very well in the future, and they invest very early into the project. And there are many steps along the way as how to do that, but one of the most important things I would say to anybody who's looking to do anything, build your credit. One of the ways I started building my credit is I was lucky enough to have a family member and a very close friend of mine who were willing to put me as an authorized user on their credit card. And that helped boost my credit score prior to me applying for my first credit card that I was accepted for. And from there, I just followed my routine, pay my bill on time, never spend more than I can afford to, and slowly but surely keep my assets and income as straightforward as possible. Like, hey, this is what I'm going to do, this is my plan for the future, this is how I'm going to get there. And writing it out makes a very big difference. Now, as for books I would recommend, you would have to kind of get back to me on that, because a lot of it is kind of self-taught. I've read a few books, not that I can remember them off the top of my head right now, because it's only because I've read them like years and years ago, and I would have to get those again so that I can actually truly guide anyone on that. But definitely reading on most books about not how to invest, but how to, I guess, how to not lose money. Like anything that teaches you, like, hey, anything that tells you putting your money only in a bank is a bad news, it's probably going to kind of guide you on the right path. Where, like, I myself, I have a brokerage account, I have stocks, I have a home that I'm looking to invest in. Like, mind you, I have one of my accounts, my second account is actually saving for my next car. The account that I have for emergency funds, I have that set aside. I actually have like a big plan that I want to do something major for my parents by the end of the year, and I'm kind of on track to accomplish that. So that's another type of savings that I'm doing as well. So everything is, you know, comparative, and it's subjective to how you're planning on moving forward and how useful you think it will be to you. But like, by all means, feel free to reach out to me. I'm more than happy to assist anybody that I can. And if I can't, I'll at least try to guide you to someone who I believe can. And then from there, you have a little bit more of a leg up on how to move forward.
Nice. Man, Mark, yeah, it's a pleasure, man.
And believe me, I have so much more I could say.
We gotta do another one. This is a whole series, so you gotta come back.
Oh yeah, definitely. I will definitely back.
Next we can be out. We gotta do this again.
Yeah, we'll figure it out.
Alright. Yeah. Yeah, that was good, man. You spent all game.
Yeah.
58 minutes.